SpaceX just went public. And somewhere in Manhattan right now, a group of bankers is watching the ticker climb. Every point higher, they smile a little wider. Not because they own the stock. Because there is a clause buried in the lockup agreement they helped write. And the higher the price runs today, the sooner that clause fires. The pop everyone is celebrating right now is not a victory. It is a countdown. And the clock is already running. Before anything else, let me be clear about what this video is and what it is not. This is not a video about SpaceX being a bad company. By almost any measure, it is an extraordinary one. It launches more rockets than entire nations. Starlink alone serves over 10 million customers across more than 150 countries. The defense contract pipeline runs deep. If you came here looking for someone to tell you the rockets will not fly, that is not what this is. This is about something different and, in some ways, more important. It is about the gap between a great company and a deal structured to benefit everyone except the person buying today. Those are not the same thing. And the gap between them is exactly where ordinary investors lose money on deals like this one. Everything I am going to show you is sitting in a public document. It is printed in the prospectus SpaceX filed with the SEC. Anyone can read it. And yet almost none of the coverage you have seen today has touched it. By the time we are done, you will have a calendar with specific dates on it. And you will understand why those dates matter far more than the opening price on your screen right now. First, let us anchor on price because it sets the context for everything that follows. SpaceX is going public at a valuation of approximately $1.75 trillion against last year's revenue of roughly $18.7 billion. That is about $94 of valuation for every single dollar of sales. 94 to 1. For a company that is currently losing money. One of the most respected independent research firms on Wall Street ran its own detailed valuation and concluded SpaceX is worth closer to $780 billion. That is more than half below the price it is going public at today. So when I say this deal was structured to favor everyone except the person buying today, that is not a feeling. That is a number. The valuation already assumes the future has arrived. Everything that follows is about who profits if it does not. Now let me build the foundation because the rest of this depends on getting one concept right. When a company goes public, only a small slice of its shares actually trades on day one. In SpaceX's case, that slice is approximately 5%. The other 95% is still held by the founders, the employees, and the venture firms that funded the company over the years. Those insiders are not allowed to sell yet. They are contractually locked up. The reason is simple. If everyone holding cheap shares could dump them on day one, the supply would crash the price immediately. So almost every major IPO uses what is called a lockup period, typically 180 days, to hold that supply back. Here is where SpaceX did something unusual. Instead of one cliff at the end of 180 days the way Rivian did, the way Uber did, the way almost every major IPO does, SpaceX built a staggered release schedule. 5 separate tranches that unlock at fixed intervals. 2 additional cliffs tied to earnings reports. And 1 performance trigger tied directly to the share price itself. That last piece is the one I want to spend time on because it is the part the headlines are not covering. Here is what the prospectus actually says. If SPCX trades 30% above its IPO price for 5 out of any 10 consecutive trading days before the first quarterly earnings report, an additional 10% of insider shares unlock for sale early. Read that again slowly. 30% above the IPO price. 5 of 10 consecutive trading days. Before the first earnings report. 10% more insider supply gets released into the market. The IPO price is $135. 30% above that is $175.50. That is the trigger number. Any trading day where SPCX closes at or above that level counts toward the 5 out of 10 requirement. And here is why this matters more than it might look. The futures market, where traders have been pricing SPCX before today, was already sitting around $155. That is approximately 15% above the IPO price already priced in before a single share traded publicly. Which means the performance trigger is not sitting somewhere the stock would have to soar to reach. It is sitting roughly 13% above where the market already expects this stock to be trading. One good week. That is all it takes for the trigger to fire and 10% of locked-up insider shares to become immediately eligible for sale. So the clause does something most retail investors will never notice. It converts the day one pop, the thing everyone on financial Twitter is celebrating right now, into the starting gun for early insider selling. The harder the stock runs in the first few weeks, the faster 10% of insider shares become free to dump. The pop is not a victory lap. It is the trigger. The higher it goes, the sooner the exit doors open. Now let me show you the calendar. Picture it pinned to a wall. Today, June 12th, is day 0. SpaceX is publicly traded. 5% of the company is in the float. 95% is locked up. Friday, August 21st is day 70. The first of 5 staggered tranches unlocks. 7% of insider shares become eligible for sale. Thursday, September 10th is day 90. Second tranche. Another 7%. Friday, September 25th is day 105. Third tranche. Another 7%. Saturday, October 10th, settling on the following trading day, is day 120. Fourth tranche. 7%. Sunday, October 25th, settling on the following trading day, is day 135. Fifth tranche. 7%. That is 35% of insider shares released across 5 dates between late August and late October. And those are only the time-based unlocks. 2 more cliffs land somewhere between them tied to earnings reports. The first cliff fires 2 days after SpaceX reports its first quarterly earnings as a public company, covering the quarter ending June 30th. The earnings release can land anywhere from mid-July to late September depending on how the company schedules its first call. Whenever it lands, 2 days later an additional 20% of insider shares unlocks. That is bigger than any single staggered tranche. And the exact date is not fixed in advance, which means the moment it arrives is something most retail buyers will not be tracking. The second cliff is even larger. 2 days after the Q3 earnings report, covering the quarter ending September 30th, with earnings typically released between mid-October and late December, another 28% unlocks. Then Wednesday, December 9th, is day 180. Standard lockup expiration. Every restriction that has not already lifted now lifts. Whatever remains of insider supply is free to trade. Add it all up. 5 staggered tranches at 7% each is 35. The Q2 cliff is 20. The Q3 cliff is 28. That is 83% of insider shares released before the calendar even reaches day 180. The final 17% unlocks at standard expiration. By mid-December, 6 months from today, every restriction on the staggered schedule has lifted. 6 months. That is the timeline worth thinking about. Not whatever the stock does in the first hour of trading. And there is one more date worth marking separately. June 13th, 2027. Day 366. The day Elon Musk's lockup ends. Musk holds the majority of voting power in SpaceX. He is the founder, the public face, the entire story in many ways. And in the prospectus he committed to a 366-day lockup. He cannot sell a single share for a full year. Not at day 70. Not at day 90. Not at the Q2 cliff. Not at the performance trigger. Not at the 180-day expiration. Locked out of all of it. Every headline tomorrow will call this a positive signal. And on its own terms, fair enough. The founder is not dumping on day 1. But here is what those headlines will not say. Every other insider, the early employees, the early venture firms, the executives below the very top, are on the staggered schedule we just walked through. Their first chance to sell starts in the next 90 days. By the time Musk's lockup even begins to lift, the rest of the inside table has had a full year of unlock windows to sell into retail demand. The person at the top is protected. The people in the middle get multiple exit doors over the next 6 months. The person buying tomorrow on their phone watching the ticker climb is the demand all those exits are pointed at. Musk does not need liquidity. His net worth does not depend on selling SpaceX shares. His lockup is a genuine signal. But the early employees and venture firms absolutely do need to sell. They have been waiting years to convert paper gains into actual money. They have fund timelines and limited partners waiting on returns. So the deal lines up cleanly for both groups. The founder gets credit for staying locked. Everyone else gets the windows to cash out. The only party the structure does not line up for is the one absorbing all of it. Let me anchor this in history because this is not theoretical. Palantir went public in September of 2020. Retail enthusiasm pushed the stock from around $10 at listing to near $40 by early 2021. Then the lockup expired. Insiders, including Peter Thiel, sold tens of millions of shares into the premium retail had built. The stock fell 13% in a single session and spent months trying to recover. The expiration date was printed in the prospectus from day one. Almost nobody buying at $38 was tracking it. Rivian went public in November of 2021. The opening day was one of the most exciting in recent memory. The stock jumped 22% above its IPO price and buyers took that pop as proof they needed to get in fast. 6 months later the 180-day lockup expired. Ford disclosed it would sell its entire stake. The stock dropped approximately 20% in a single day. Over the following year it fell 67% from its peak. Every date was visible to anyone who looked. Uber went public in May of 2019 at $45 a share. By the time the lockup expired in November, the stock had been struggling. And on the very day insiders were finally allowed to sell, it hit an all-time low. 40% below the IPO price on the expiration date itself. Even Snowflake, which used a staggered schedule, the closest analog to what SpaceX is doing, was not immune. The final expiration week alone dragged the stock down about 11%. The pattern across all of these is clear. The higher the speculative premium at the IPO, the more painful the expiration tends to be. SpaceX is going public at roughly 94 times last year's revenue. That is the highest premium of any major IPO in years. By that measure, the room for things to get difficult during the unlock windows is unusually wide. None of those companies were bad businesses. Most are still around. Some have recovered. The point is not that SpaceX will collapse. The point is that the part of the deal that hurt retail investors in every one of those names, the unlock, is the part that is still ahead of us in this one. So where does that leave you if you are genuinely drawn to this company? There are 2 loud options and 1 quiet one. The first loud option is to chase the hype. Buy today at the popped price right before the performance trigger window opens and the staggered tranches begin unlocking. We have now walked through step by step why that is the weakest position in the deal. The second loud option is to write off the whole thing forever because the structure was unfair on day one. That throws out a genuinely remarkable business because of how it was packaged. The third path is quieter and it costs you nothing but patience. You let the calendar do the work that hype is trying to rush you past. 6 months from now, every restriction on the staggered schedule will have lifted. The Q2 earnings report will have landed with real numbers you can hold the company to. The Q3 earnings report will have landed as well. The performance trigger window will have closed one way or the other. The Nasdaq forced buying from index inclusion will have run its course. Every one of those events is a piece of real information replacing speculation. None of that requires you to predict anything. It just requires you to not be in a hurry. Here are the dates worth marking. Late August through late October for the 5 staggered tranche windows. Somewhere between mid-July and late September for the first earnings cliff and the 20% unlock. Somewhere between mid-October and late December for the second earnings cliff and the 28% unlock. December 9th for the final 180-day expiration. And June 13, 2027 for Musk's personal unlock. By the time that last date arrives, the price will reflect a year and a half of reality instead of one morning of hype. That is the price worth making a decision on. Not the one on your screen right now. The best companies of the last few decades stayed investable for years after their IPOs. You did not have to own them on day one to do extraordinarily well. The market rewards patience far more reliably than it rewards urgency. The thing being sold to you today as a once-in-a-lifetime act now moment is almost always a stock that will still be there next quarter at a price set by reality instead of by a countdown clock. The most important habit this video can give you is not the calendar. It is the practice of looking at deal mechanics before deal headlines. That habit works on every IPO you will ever consider. The trigger clauses, the unlock schedules, the float math, the index inclusion rules, they are all sitting in public documents before the price action ever starts. The advantage is not access. The advantage is reading. The number on the screen today is loud. The calendar is quiet. The number fades in a day. The calendar runs for a year. Pick which one you let make your decision.